Welcome back to Startup Accounting 101. This is a video series for founders to understand accounting fundamentals for running a business. We are continuing through the financial projections template. It is available for free from score.org. Go to the template gallery and download the file. I'll have the link in the description below. This video, we're covering the first of the analytical tabs. This is the break-even analysis. This is only for year one, but you can perform this for any year. So let's read the note together about break-even sales levels. So the break-even sales level represents the number of units that must be sold in order to break even. This means that revenues are equal to expenses. Any units sold beyond this number will allow the company to generate net income. So one of the best uses of the break-even analysis is to play with the various scenarios. We did some scenario planning back in the common size video, so check out the video to learn more about that. I'll link that video sort of in the corner. It should show up in the left-hand corner. So some of the examples here are, for instance, if you add another person to the payroll, how many extra sales dollars will you need to cover the extra salary expense? If you borrowed from a line of credit, how much would you need to cover the increased principal and interest payments? Many owners, especially retailers, like to calculate a daily breakdown, like the daily break-even number. And this gives everyone a target to shoot at for the day. So there is an equation here for the break-even analysis, sort of down here. So the break-even point is the total fixed costs over gross margin / total sales. And this, so there's the calculation over to the left here. So we'll just go through it. So this gross margin over totals, that amount is here. So the gross margin, and I will split screen this to kind of show where the numbers are kind of pulling from. So we've got gross margin, it's coming from income statement 1 to 3. So that's here. This gross margin number here is sort of just pulling this number over the total sales. So referencing back the common size. So this was actually the same number here, 86 or 85.8. If we added another decimal point, that's the same percentage. So in terms of common size, this would be the gross margin percentage for the financials. So here we have this number, this calculation is 85.6%. So that's the second half of this equation. And then the first half is the total fixed cost. So the total fixed cost for the business here is payroll and operating expenses. So these are going to be pulling from the payroll numbers. So the payroll from the first year. And then this number, the operating expenses, that is coming from here. So the total fixed operating expenses for the year, it's pulling here. So we've got the 247K is getting pulled here. So both of these together is giving the total fixed expenses number. So here it's sort of repeated. So we've got 85.6%, which is the gross margin percentage, over the total fixed expenses. And so the calculation here is, okay, this is the total fixed cost. So this is the dollar value divided by that gross margin percentage. So this break-even analysis shows that in order just to break even for the year, we would have to sell $762,000 or generate this amount of revenue just to break even, to cover all of the costs. So this is the amount per year. And then this is the amount per month. So this is just the yearly break even amount divided by 12. So every month you have to hit this number in order just to break even. So if we looked at the income statement here for the year, for the first year, and if we looked at the revenue amount, we have to have at least 63K, and for the entire year we at least meet that number. So we've got 67 across the board until the revenue spikes up in October, and that's 136. So for every year we at least for every month we at least break even, and over the entire year we also cover by almost 100K. So we exceed by over 100K. And so once we calculate this number, we can actually do as they recommend, which is various like scenario planning. So we can go ahead and make just one of the recommendations. So let's say we wanted to hire another person in year 1. So if we go back to the payroll numbers, or payroll tab here, you can say, well, okay, let's say if we hired another full-time employee for the year, what would happen? So you can up this up to 2, and we can see that the monthly breakdown goes up. So before it was 63K to just break even, now it's 71K. So that's a huge jump. And if we go back to the financials here, 67, like we don't meet that number for most of the months except for October. We do meet that. And the yearly breakdown, like we barely cover. We're about 20K over, and that gives us a really slim margin. So the net income before, it was pretty high at like 9%. Adding another person dropped down the net income from 9 to 1%. So that should tell you that we probably can't afford another full-time employee. Now, if we can go ahead and put it back to 1, but let's say we want to hire another part-time employee. Can we do that? So if we add another part-time employee, go from 2 to 3, we can say, well, actually, the monthly break-even amount only increases $2,000 per month in order to add another part-time employee. If we go back to, let's go back to income statement here. Actually, I'll do per year, per the year 1, every month. Here, the monthly breakdown, break-even amount is 65K. The total revenue is 67, so we're barely kind of clearing it, and of course October we double that sales. So over so every month we're barely, getting by, which is the whole point of the break even. Like we are able to cover our expenses, but over the entire year we need 786, and here we have 878, which is a decent margin. If we go to percentages, it drops down to 7%, but it's still, it's still feasible. It's still reasonable to, and this break-even analysis shows that if needed, we could afford another part-time employee. Now I'm gonna put this back to 2. To go back to, just to reset it to where it was. So you can adjust different parts of this template, do different types of scenario planning. You can also run a super quick break-even point analysis to know if you can afford something very specific. So if you don't want to adjust anything on the template, you can take this equation and plug in a new expense. And just know that these expenses, these fixed expenses, should fall into one of these categories, one of these fixed expense categories. So it could be rent, it could be marketing. So if we do one scenario, let's say you want to expand to a larger store, and the rent overall will increase by 50,000 over the year. We're going to increase our rental expense by $50,000. So here I can redo it. So this is the break even point analysis is the fixed cost, which is 50,000. We want to see if we can expand to a larger space, commercial space, divided by the gross margin percentage. So this tells me that in order to expand to a larger space, for the year we have to generate $58,000 worth of sales to break even, to be able to cover the costs, the increased rental cost, and that breaks down to every 12 months, every month we need to increase our sales by, let's say, $5,000. Now if we looked at like what does that mean, like $5,000, if we go to the sales tab, where's the sales forecast, we see that these are the sales per unit. So if we say, conservatively, the lowest price point for sales is Costco. So if we take the amount of sales per unit, which is $225 at Costco, so that's what we're pulling in here. This is the number of bars we actually have to sell every month, in addition to what our sales projection already is at, which is 10,000 bars at Costco. That's sort of the estimate per month. We see that in order to afford this new expense, we would have to sell an additional 2,100 bars in order to break even. Right? So given our normal sales volume is about 10,000 bars to Costco, we can run an analysis saying, okay, 2,100 divided by 10,000 is 22%. So the PO volume from Costco, let's say PO from Costco needs to increase by 22%. Now, can that be done? So this break-even analysis is giving, a general overview of what would need to happen in order to afford either a new expense or just to cover our expenses. And of course, any sales above that would lead to profitability and net income. So if we go back to here, this scenario here, so the Costco PO or purchase order coming in would have to increase by 22%. So can this be done? I think the sales team would have to look at the numbers, look at the projections to see whether it's feasible. You can look at the incoming, purchase orders and to analyze the trends. Is it trending up? And so this break-even analysis is able to tell you whether it's reasonable, whether the forecast that you have is reasonable. And any additional expenditures, any major expenses, it could be increasing rent, it could be increasing marketing, just any new expenses you have, like how much do you have to sell, bring in revenue in order to cover that cost. Okay. So with that, we have covered the break-even analysis. The next few videos, I think, will cover financial ratios. There's a lot going on here, so I may have to break it up into like 2 videos. And we're nearing the end of this particular template. We're almost done with this template. So please recommend any topics that I can cover. Like and comment if you enjoyed this video. Please subscribe, and thanks for watching.